Hi everyone, I am Eduardo Zilberberg, partner at Bronstein, Zilberberg, Chueiri Potenza, and I co-head the venture practice. By way of introduction, Bronstein Zilberberg is one of the top transactional firms in Brazil. We were the most active in M&A and investment rounds for the past 2 years in a row. We acted on more than 300 transactions for the past couple of years, and we're happy to be here today.
Hi, I'm Evelyn Rolo. I'm the head of the Labor and Management Compensation practice. We have a very specialized team here at BZCP that is very used to, design and draft and implement short-term and long-term incentive plans, linked and not linked to stocks in Brazil and offshore. And we are here today to talk a little bit about the types of incentives, the nature and the costs, and also how companies deal with such incentives in a liquidity event on a corporate perspective. So let's start.
First off, it's very important to say that stock option plans are crucial to the business strategy of any company. The employees are the heart of the company, and if they're not well incentivized, it's very hard to build a successful business. In certain circumstances, the option pool can also be a highly debated item. When an investor is looking to invest in a company, he's going to look very carefully at how employees are incentivized. Many companies have a long cycle from inception to an exit event, and the employees need to carry the company and the business for several years. And so it's really important for the company to think about its long-term incentives, how it's going to structure long-term incentives based on the business strategy, the employee pool, and the incentives that it wants to create.
Well, we can divide the incentives in two main groups. The first one is the ones that are not linked to stocks, and they usually prioritize individual performances, retain employees for a shorter period of time, and they usually have a limitation on the gains because the employee already knows how much he's gonna get after achieving some predefined goals and objectives. And for example, we have in this specific group profit sharing. We have retention bonus, performance bonus. The first one needs to involve the union. The last ones can be executed directly with between the employee and the company. And we also have benefits that are linked to stocks, or at least to a stock value, such as phantom stocks and RSUs, which are the restricted share units, and stock options. And these specific incentives, they are usually granted to executives and employees in higher positions. They aim to engage and align collective interests. They are usually considered as long-term incentive plans. They do not have a cap on the gains. And also they aim to put the employee on a responsibility of growing the company. So the size of the bonus will be how much the company is going to grow in a specific limit of time. Stock options in Brazil, they are the most common long-term incentive plan, especially among early stage companies, because of the cost, because they are very easy to implement, and also because the employees in Brazil, they understand how this incentive works. So Eduardo, can you please tell us a little bit how these companies, these startups, early stage and late stage, usually see stock options in Brazil, if they apply these incentives very often or not?
Yeah, so as I said, when thinking about the management incentives that you want to create, they have to tie nicely with the company's business model. and long-term objectives. There are different types of incentives, and depending on the life cycle of the company, you may implement one type of incentive and then switch. So, for instance, if we're talking about an early stage technology company that plans to grow through various investment rounds and reach a liquidity, in a period of 5 to 10 years, reach an initial public offering or a sale to a strategic. For that company, in the early years, probably a stock option plan that has a strike price that the employee needs to pay in order to exercise the option, with a long-term duration. So it's usually 10 years duration. The employee has 10 years to exercise the option. That's probably going to work better in the first few years for several reasons. One is that the company is usually strapped for cash, low on cash reserves, and the more compensation-based management incentive plans are they have a very high cost for the company, whereas the stock option plan has zero cost, no disbursement for the first few years. The idea is that the employee needs to vest. Vesting is usually at least 4 years. So the employee is going to have to vest before he can exercise. And most employees will wait for a liquidity event that is 5 to 10 years down the line before they exercise. So they can wait for a long term before they have to effectively disburse any amounts or exercise the option. And the company won't have to withhold any taxes until the point where there is a liquidity event. So the other feature is if the employee leaves, he will have to exercise the options. Now that is in terms of company cap table, which is also very closely looked at by investors, is very important to have a healthy cap table. Now, if throughout the company's cycle, you may have dozens of employees that spend only a couple of years at the company, they will have the option to exercise what they vested, but they're going to think twice because the option may or may not be in the money. And so if they're leaving the company, they may not want to take the risks. And so you have to have skin in the game, right? The employee needs to effectively pay a price and be willing to run the risk of losing his money. And so it also helps the company when not every single employee decides to exercise, especially the ones that leave. And so it's also important both in terms of preserving cash and preserving ownership in the company. As the company matures, the valuation will hopefully grow, and it's going to be more difficult for the employee who wants to exercise and who's going to stay with the company for several years to do that if the strike price is really high based on the valuation of the company. And so companies at that stage typically switch to an RSU model in restricted units where they don't have a cost to exercise. On the flip side, when they do exercise, the company needs to withhold taxes. And so it can be expensive for the company, but hopefully at that point, the company is going to be in a much better cash flow position to do that. So you can use more than one type of incentive plan at the same time or switch throughout the life cycle of the company.
Well, and talking about costs, the general rule is that all benefits have compensation nature, meaning that they should be basis for labor charges and social security and income tax over remuneration. However, we have some exceptions to this general rule. which is the stock option plan. When such plan has, as Eduardo said, a strike price equal to the fair market value by the time of the option grant. So the employee needs to necessarily make a financial investment to purchase the shares. And also the employee needs to, bear the risk of stock devaluation, meaning that the employee needs to take the risk of losing money, and also the employee needs to voluntarily adhere to the incentive plan. So he needs to sign a stock option agreement. If all these elements are observed on a stock option plan, this stock option plan will have a commercial nature and will not be basis for all these labor and social security charges. The employee will only be required to pay income tax over capital gain up to 22.5% versus remuneration nature benefit, which is very expensive to the company because the company will be required to pay around 60% on top of the incentive as labor and social security charges. So when we talk about RSU, when we talk about phantom stock, retention bonus, and performance bonus, they are basis for all these labor charges. The stock option plan can or cannot be basis for these labor charges, depending on whether the company will observe these elements or not. And the risk will be higher, much higher, when the company decides to, for example, grant a discount over the fair market value, or if the company decides to, grant shares without imposing a strike price to the employee. And this will increase the risk of having a stock option plan being considered as a compensation nature benefit.
So now I wanted to talk a little bit about the liquidity event, which is in many cases when the employee finally gets to share in the results and the profits of the company. Now, the first thing that we should emphasize is that there is no guarantee of a liquidity event. That's tricky because at the same time you have to sell the company to the employee. You have to sell the highest possibility of the liquidity event happening. But at the same time, from a legal perspective, you have to make sure the employee is aware of the risks. Not only the risks that the liquidity event might never happen. In fact, statistically, it's more likely than not that the liquidity event won't happen. But also the risk that the option pool or the employee's stock options will be out of the money, in which case the employee won't exercise. And so the employee really needs to be willing to bear these risks in order to be the ideal candidate for a stock option plan. And that's why stock option plans are not for everyone. If employees would rather have a 5% bump on their salary as opposed to receiving stock options, then maybe it's better off giving that salary bump instead of giving a bunch of stock options that they could allocate to someone who really values them and who's not afraid of running the risks. There are some mitigating factors. So some companies implement liquidity programs that are typically associated with investment rounds that the company will receive along its life cycle, at which point they have the chance to get some liquidity on their stock options. And we're also seeing many initiatives of companies that will purchase stock options from employees of other companies. So there are many ways to try to mitigate the lack of liquidity, right, that the employee has. And you can also mix, as we said, with a stock option plan with other types of incentives. The topic of acceleration is very controversial. Employees expect, in the case of an initial public offering or a sale, they expect that they'll be able to sell all of their stock options And that's not always true. In fact, most plans will give the board the flexibility of accelerating the stock options or not, depending on the negotiations with the buyer or the plans for after an IPO. Once the company IPOs, I mean, that's just the beginning of the story. So it may be important to retain employees. If every employee accelerates and is able to get liquidity, maybe they're going to be less incentivized to stay in the company. And this is especially important for stock options that are granted right before the exit event, where the employee hasn't really stayed in the company for a long time. In general, the company needs to have all these things in mind when deciding to implement a management incentive plan. Thinking about the business model, its cash reserves, what is the long-term goal? Is it reaching a liquidity event or reaching profitability? Depending on those objectives, the company needs to think about the most appropriate management incentive plan. And this is a very crucial topic, very strategic, and there are important legal implications. So we've touched on many important topics today.
That's what we have for today, and thank you very much. Our contacts are here at the QR code, so feel free to reach out and see you next time.
Bye-bye. See you soon.